Folks, let's talk about your money, your hard-earned money. You go to work every day, you trade your time for a paycheck. But what happens next? Does that money just sit there? Does it disappear on things you don't even remember? Or does it start working for you? Building wealth isn't just for the super rich, it's for everyday people. It's about having peace of mind. It's about having options. Now, when I say capital markets, some of you might tune out. You might think it sounds too complicated. Too Wall Street. That's just not true. The capital markets are simply where people and businesses with money connect with those who need money. It's a place where your savings can grow. Ignoring how this works is like trying to build a house without knowing how to use a hammer or a saw. If your money isn't growing, it's actually shrinking. Why? Because of inflation. Understanding capital markets means you can put your money in places where it has the potential to outrun inflation. It means your money can start generating more money. That's called compound growth, and it's a beautiful thing. So stick with me, let's get started. Imagine a giant factory. This isn't a factory that makes cars or widgets. This factory produces wealth. That's what the capital markets are, folks. Think of it as the wealth-building factory. It's a system, a process, designed to help money grow. It connects people who have saved money, the investors, with businesses and governments that need money to fund their projects and operations. This connection is what makes the economic wheels turn. The raw materials for this factory? That's your money, your savings, your investments. Even small amounts when consistently put into the factory can become something much bigger over time. The factory can't run without these raw materials, it needs capital. So, when you invest, you are supplying the essential ingredients that this wealth factory needs to operate. You are becoming a part of the production process, not just a consumer. And what does this factory produce? The output is financial growth. For the businesses, it's expansion and profit. For you, the investor, the product is a return on your money. Alright, let's look at the first key tool in our capital markets factory: bonds. Think of a bond like an IOU. When you buy a bond, you are essentially lending your money to an organization. This could be a company, a city, or even the federal government. They need money for their projects, and you're providing it. You give them money now, and they promise to pay you back later. You become a lender, a creditor. The organization that issues the bond promises to pay you back the original amount, called the principal, on a specific date in the future. This is known as the maturity date. Along the way, they usually pay you a fixed amount of interest. These interest payments are typically made twice a year. Because these payments are generally fixed and predictable, bonds are often called fixed income investments. You know what you're getting and when you're getting it. This predictability is one of their main attractions for many investors. So, what are the benefits of bonds? Well, the biggest one is usually lower risk compared to something like stocks. Section 4, tool number 2, stocks, the growth engines. Now let's talk about the other major tool in our wealth-building factory: stocks. Buying stock is very different from buying a bond. When you buy a bond, you're a lender. When you buy stock, you become an owner. That's right, you own a piece, a share of that company. Whether it's a giant corporation or a smaller growing business, buying stock means you have a stake in its future success. If the company does well, makes good products, serves its customers, and earns a profit, the value of your shares will likely go up over time. This increase in value is called capital appreciation. That's one way you make money with stocks. Another way is through dividends. Some companies, especially well-established ones, choose to share a portion of their profits directly with their shareholders. These payments are called dividends. So you can benefit from both growth in share price and income from dividends. The big benefit of stocks is their potential for higher returns compared to bonds. Over the long term, stocks have historically provided better growth than most other asset classes. Section 5, building a strong portfolio, the power of teamwork, stocks and bonds. So, we've talked about bonds, the steady eddies. And we've talked about stocks, the growth engines. Now, which one should you choose? The answer for most people is both. You've all heard the saying, don't put all your eggs in one basket. That is absolutely critical when it comes to investing your hard-earned money. Relying on only one type of investment can be risky. Diversification is key. Think of stocks and bonds as players on your financial team. Stocks are your offensive players. They are out there trying to score big points, aiming for growth. Bonds are your defensive players. They are there to protect your capital, to provide stability, and to make sure you don't lose too much ground when the market gets rough. A good team needs both offense and defense to win consistently. Your investment portfolio is no different. Section 6. Don't learn the hard way. The cost of waiting. Many folks put off learning about investing. They think it's something they'll get to later. Maybe when they have more money, maybe when they're older, or they think it's just too complicated for them to understand, so they don't even try. This is a huge mistake, folks. Waiting is one of the most expensive financial mistakes you can make. Every day you wait is a day your money isn't working for you. It's a day you're missing out on the power of compound growth. Time is your greatest ally when it comes to investing. The earlier you start, even with small amounts, the more powerful compounding becomes. Compound growth is when your investment earnings start earning their own earnings. It's like a snowball rolling downhill, getting bigger and bigger. But that snowball needs time to grow. Section 7. Your blueprint for success. Early education and smart choices. Folks, financial education is not a luxury. It's a necessity. It's the power to take control of your life and your future. It's not just for Wall Street wizards or people with fancy titles, it's for you. It's for every single person who wants to build a better financial future for themselves and their family. Understanding how money works, how to save it, how to invest it wisely. These are fundamental life skills. And the good news is, it's not rocket science. You can learn this stuff. You absolutely can. The best time to plant a tree was 20 years ago. The second best time is today. The same is true for investing. Start now. I don't care if you only have $20 to start with. The habit of saving and investing regularly is more important than the amount when you're just beginning. Those small, consistent steps taken over a long period will lead to big results. Don't let the feeling that you don't have enough money stop you from starting. Start where you are with what you have. Once you start, you need to be disciplined.